Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend, or I'll hit you in the face with a brick. What? I can't say that? Today we're going to be looking at the bear channel. This is a continuation signal and a bearish signal on the condition of a bear channel. Channels can be bullish or bearish. In this particular case, we are looking at a bear channel. The main difference between a channel and a rectangle will be that the rectangle chart pattern is horizontal. There's no positive or negative slope to it, while the bear channel obviously has a negative slope. The first thing you're going to note here when you're looking at one of these is the main trend line. This right here, okay, this main trend line right here. You got to have at least two main points to draw that trend line on it. Preferably, you would have more than that. You don't want to be too quick to call a channel formation thinking it's bearish or something, and then find out later on that it's actually a descending wedge or something of that nature. You don't want to get those wires crossed. So that's why it's important or preferred to have multiple peaks to run that line across. Okay. Once you've run that first trend line and your resistance level there, you can simply take, and stockcharts.com allows you to simply grab this and duplicate it. You can run a very simple method and pull it out, and it'll give you a perfect parallel. That's what you're going to do to get the channel line right here. The channel line is basically, there's two ways to do it. You can set it at the low points, typically low point here, low point here. You've got to have at least two to draw a trend line, but again, more the merrier. And you can simply draw that trend line out across those low points. They don't have to be exact, but pretty close. Some guys will also, instead of doing that, they will simply find the lowest point in the channel and draw their trend line there, their parallel trend line at that point. I understand why they do that. They're doing that to keep themselves from being unnecessarily stopped out. For example, if you were over here and you had to stop here and you're waiting for the bounce and shorting here and then playing this game over and over again, you could find yourself in situations where price activity moves a little bit further than you expected. Then you try to get back in, you're chasing stock, it's not good. However, to set your trend line at the lowest point, you have to know where that lowest point is. So I don't really think it works all that well. I mean, this over here you may have considered the lowest point at that time, but down the road, it's no longer the lowest point. Now it's over here. You're going to keep adjusting every time you get a lower low. It's up to you how you trade it. I would personally just keep it as close to the support lines as possible. And the support line is obviously right there. You do have a pierce over here, jumps back above it and starts respecting it again before it breaks down. All right, let me clean this chart up very quick. Get rid of those. Okay. To trade this is quite obvious. You'd simply, on a bear channel, look for opportunities to go short. Once you had your two lines, you've drawn it out, you can find situations, maybe here we went short, a stop just above that previous high. Your highs are going to keep going lower and lower. Taking a low one here, maybe had one here, and just trade it down to the support line and then exit, and just keep repeating that process again and again. I wouldn't personally try to go from the long side in a bear channel, because at some point in time this is going to happen, so I prefer not to trade that side. In the case that we'll get to a bullish channel later, but in the case that price activity actually pulls back down and closes below your support line, once it's closed below that, it's considered that price activity, the sell-off, is increasing in momentum, and that's a really big move to the downside. It's expected thereafter. You can get a price target for how low you expect it to go once it has broken down by simply taking the distance between the two bars or the two trend lines and then adding that or subtracting that to the breakout point. Again, targets are only to be used as targets. They're not set in stone, so keep your wits about you, but it gives you some idea of how low you expect price to fall. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.